Good evening, everyone, and welcome along to this ATFX presentation, which is all about mastering Japanese candlestick patterns. My name is Chloe. I'm with Trade with Precision, and this webinar is brought to you by ATFX in association with Trade with Precision. So before we get started, as per usual, I would just like to give you a couple of moments to read the disclaimers and risk warnings. Just to give you a couple of minutes or a couple of moments, sorry, to have a quick look through that. And as long as you agree with everything therein, we will get started with the presentation. Also, I'd love to hear from you in the questions box if you want to introduce yourselves. Let me know how long you've been trading. Or if you're a complete beginner, more advanced, what stage you're at, then I can try and tailor the presentation a bit more to your needs. Okay, there's just one more risk warning slide here for you to have a look at, so I'll give you a couple of moments on that one. And as long as you agree with everything therein, then we can get started with the presentation. Hi, Pramit. No problem. A lot of complete beginners in here, so we will make sure that we cover the very basics. Okay, so let me go through the agenda for today. Today we are going to talk about Japanese candlesticks. Japanese candlesticks are probably the most widely used way of displaying price action. And they have a historic basis on trading from Japanese rice future traders, and they've come all the way through to the modern day, and we use them for our modern day technical analysis as well. So we're going to look at how East meets West, combining both candlesticks and other technical tools to improve the reliability of the trading signals. We're going to have a look at understanding the different multiple candlestick patterns. We're going to look at combining candlestick analysis in a trading strategy. And then we're going to have a real-time analysis of the current popular market price action and any potential opportunities that may currently be setting up. And then to finish off, a little bit about ATFX. In fact, what I'm going to do is I'm going to take you through those ATFX slides now so that they're done, and then we can spend the rest of the time on the program, on the ATFX MT4 platform going through live data. So why choose ATFX? They are regulated by the FCA, the Financial Conduct Authority. So that is very, very important indeed to get a broker that is regulated in a country such as the UK or Australia. And they have an efficient, secure, easy to use payment portal. ATFX is committed to providing competitive prices for our clients. They use global investors' most widely used trading platform, which is MT4, and we will be having a look at that very shortly. And they have a bespoke customer service and trade support for all client trading needs 24 hours a day, 5 days a week. They are the winner of Online Personal Wealth Awards 2018, that's just last year also. So you can open a live ATFX account today. The phone number details are there for you, and that is from within the UK and also from outside the UK. There's 2 phone numbers there for you, and those phone lines are open Monday to Friday 9 till 5 p.m. There's a postal address there for you as well, and also the customer service team email address is there. So the sales inquiries, sales.uk@atfx.com, and the support email address, which is cs.uk@atfx.com. So those are all the contact details that you need should you wish to get in touch with ATFX for any reason whatsoever. And with that, I am going to take you straight through to the MT4 trading platform, and we will have a look at the charts and go through some charts to have a look at these candlestick patterns. So here we have the ATFX MT4 platform. Now what I've done here, those of you who are complete beginners, I might just start afresh because I have a completely blank chart up here. But if you were to want to get a chart up for yourself, I'll just quickly take you through that. I'm just going to right click on the currency pair, which I see over on the left hand side in the market watch. I'm going to click on chart window, and the default setting, you should get a chart window that looks a little bit like this. And actually we see that these are price action bars. These are OHLC bars. In order to change that, I just need to click up here. Let me see if I can get this pen working. Up here, I just click on the picture of the candlestick there, and that will change the chart to candlesticks. What I'm also going to do is I'm going to right click on the chart, I'm going to go to properties, and I'm going to change my color scheme. So I'm going to change the background to probably something just off-white maybe. How about that one? I'm therefore going to change the foreground to black. I'm going to turn the grid off. I don't like to have the grid on. And then I'm going to change my colors. So the bar up, I'm going to keep as lime. Bar down, I'm going to have as red. And then here, bull candle, I'm going to have as lime. And bear candle, I am going to have as red. That is pretty much all I need to do, and then I'm just going to click OK, and there I have a pretty nice clean candlestick chart. Hopefully all of you guys can see these candlesticks clearly. Is everything clear? Are those colors okay for you? Hopefully they should be. I usually find that when I'm presenting a pretty much white background and these colors are okay, so perfect, thank you. Okay, so first of all, I am going to start by looking at individual candles. So most of you, I imagine, will know that each of these candles represents a period of time. So here you can see I'm on the 1 hour chart. If I go to the daily chart here, this is the daily chart, and that means that each of these candles represents 1 day. So on the hourly chart, each candle would represent 1 hour. On the 4 hourly chart, each candle would represent 4 hours, etc. So the candles represent all of the price action that takes place in that period of time. So I have the daily chart up here. Each of these candles represents 1 day. And so I'm just going to take a look at this candle here. What I've got here is I've got a body of the candle. The big green bit that we can see, that is called the body. The body can be green or red. Green would mean that it is a bullish candle, which means the buyers are in control and price has gone from low to high. Red is the opposite. So let me just start by saying that the body of the candle shows where price opened and closed. So here, this is where price opened. The day started with price at this level here. And then price closed at the end of the day up at the top where I'm marking there. Price also moved throughout the day, and these things here are the wicks. You can see a fine green line there at the bottom and another fine green line at the top. Those are the wicks. So those are the candlestick wicks. And so we've got the high up at the top there and the low at the bottom. So the candlestick represents 4 prices: the open price, the low price, the high price, and the close price, all for that 1 day. And what has happened here is price has opened at this level here. Price has gone down. Price has come all the way back up. it's tested this high up here, it's come down again, and it's closed at this level here. Does that make sense to everyone? Hopefully it does. So I'll use the next red candle as an example here. So price has opened here at the top of the body of the candle. Price has traveled up to the top. Price has traveled down. Ooh, that is a terrible line. Apologies for that. Price has traveled down to the bottom. Price has come back up, and it has closed at the bottom of the body of the candle there. And then the subsequent candle opens where the previous candle closed. Price trades up to the top, down to the bottom, comes back up and closes down here. So we have a series of candles showing us where price is opening, where price is closing, and where price is traveling throughout that period of time, which in this case is a day because we're on the daily chart. So what this means is that for every period of time in this example day, we can see who is in charge of the bars, whether it is the buyers or whether it is the sellers that are in charge of each of these candles. So if the candle is green, that means price opened low and closed high. That means that for that period of time, the buyers were stronger than the sellers. They pushed price up, it closed higher than it opened, and that is a bullish candle. That indicates bullish price action and price going up. If we see a red candle, that means that price opened higher than it closed lower, which means the sellers pushed price down. The sellers were in charge of that period of time. The sellers overpowered the buyers to push price down. It closed lower than it opened, and we get our red candle. So just knowing these few very, very basic things can help us very much in our analysis of the markets, because we can see on any given day, and in fact in any given time period, whether that's 4-hourly or hourly, or even down to 5-minute lower time frames even, we can see who is in charge of each of these candles. Now, when we start to put the picture together by combining multiple candles, we can get even more information. First of all, I'm going to have a look through and see if we can see some significant candles that really indicate a strong directional bias. Now, I'm looking specifically at these two candles that we have in the middle here. So these candles are, we can see here that the body of the candle is very small, and the wicks of the candles are very long on one side of the candle in particular. Let me just zoom in. That's as far as I can zoom in. So here we have the body of the candle is very small here. The wick on the upside is very long. The wick at the bottom is small. So the body of the candle is pretty small, and it is in the bottom part of the candle overall. It's in the bottom, I'd say bottom quarter or bottom third of the candle. And what this means is that for this particular candle, price opened here. The sellers pushed price down a little bit. The buyers pushed price all the way up to the top here, but then the sellers came in again, overpowered the buyers, and actually caused the price to close pretty much down where it opened. So this, even though it's a green candle, it actually is a bearish candle, because overall the sellers were the strongest. What's the most important thing is the closing price, and the fact that the price closed near where it opened is more significant than the fact that that price went up here in the first place. So where the closing price is, that means that sellers took control of this period of time, and actually the bar closed low, and therefore the sellers were in charge. And what this means is, since the sellers have been in charge in this last part of the day, or last part of that period of time, the likelihood is that price could continue in that direction subsequently. And we can actually see that in this chart, because we can see that after we had this bar here, we had price going up. Then we saw this bar here, and then we saw a change in direction and price come all the way back down. So that can tend to indicate what direction price might move in next. Let me see if I can find, there's another example here actually, and this is the same candlestick pattern, but the opposite. So here price has opened at the top here, it's traded all the way down to the bottom, but the buyers have come back into the market and forced price all the way back up to the top, and price has closed near the top. So the body of the candle, even though it's red, the body of the candle is in the top third of that with a long tail at the bottom. This means that buyers have taken control in this period of time, and the likely direction subsequently is going to be up. It doesn't mean price is definitely going to be up, but it does give an indication that the buyers are the strongest in the market at the moment. We have got some other types of candlesticks. Let me see if I can find some of them. We can see, I mean, if you take a little bit of time to look through your charts, you will find these all over the place, and they really can help to give an indication of direction. So I strongly encourage you to have a look through your charts and see if you can find some of these candlestick patterns that I'm going to point out to you. Now, let me see if I can find the next one that I want to talk about, which would be now, one thing to note is that I'm looking at a currency chart here, and because currency markets are open 24 hours a day, that tends to mean that it's quite rare to get gaps in the market. We can see that we've got a gap in the market here. We've got a bit of a gap in the market there as well. That's relatively rare in currency markets, because on a daily basis, because the markets trade for 24 hours a day, the price will tend to close and open at the same place. The exception to that, of course, is over the weekends, when, of course, the markets close on a Friday night and they open again on a Sunday night. And therefore, if there has been some kind of news or some kind of movement over the weekend, we can see gaps therefore. So I would hazard a guess that this was, yeah, it was a weekend, 21st of April, 24th of April, 2017. I was wondering why that was a weekend when we've only just had the 24th of April yesterday, but we're looking at 2017 here. So 21st of April, that would have been a Friday. 24th of April, that would have been a Monday, and that's why we can see a gap in that market. But usually we don't tend to see gaps in currency markets. There's another one there, which was from the 24th of March to the 27th of March. So again, over the weekend, days that follow one another, Monday, Tuesday, Wednesday, Thursday, Friday, they don't tend to gap on the currency markets, because the market does open and close simultaneously at midnight. Question here, let me see, is the PDF available? This isn't a PDF. This I am I'm literally just live on the charts here. I don't have a PDF to give you from this. I'm just going through the charts live to pick out some of these candlestick patterns. So let me see if I can find another pattern that I would like to share with you. There is an example. It's not the best example. Let me see if I can find a better one. There is an example here. It's not the best example, but it will illustrate anyway. What I want to look at is bullish and bearish engulfing patterns, and also bullish and bearish inside bars. So inside bars I'm going to look at first of all. Now they really are what they say on the tin. What we've got here is we've got, and if to have an inside bar, you have to look at two bars. So 1, 2. We're looking at these two bars. Bar number 1, the high of the bar is up here, the low of the bar is down here. Bar number 2, the high of the bar is lower than the high of the previous bar, and the low of the bar is higher than the low of the previous bar. So the entire candle, the body and the wicks, the entire of bar number 2 fits inside the whole of bar number 1. So that is an inside bar. The second bar is inside the first bar. What that can indicate is it can indicate indecision in the market, and it can suggest that perhaps the market may change direction for a period of time, and we can see that here. So we have really strong bullish price action. We can see these big green candles, and then we see this indecision in the market, and then price changes direction. It doesn't change the trend. We can still see that the trend is up overall, but it does just indicate a little bit of indecision here. The sellers are coming back into the market. Price now retraces back down slightly before continuing upwards, and we can see this again actually here. Bar number 1, bar number 2. Bar number 2, the entire bar from the high to the low is inside the entire of that previous bar, and we then see a change in direction. So again, it's like a pause in the market. Neither the buyers nor the sellers have been able to push price above or below that previous day's price action. So it means that there was indecision in the market for that day, and that can often be followed by a decisive move. So that is another one that's worth looking out for. And then the other one that I want to look at is an engulfing bar. Let me see if I can find an engulfing bar for you. Here's one here. All of these candlestick patterns, that's a really good question. Does it only work with currencies? No. All of these candlestick patterns are relevant to any market that you look at. So any market that you have up on your charts with your candlesticks, you can read the candlesticks in the same way. So I read currency charts. I also read commodities. I read metals, gold, oil, sugar, any kind of market, orange juice. All of the markets that I look at candlestick patterns, and they are the same across all of the markets. So what I'm looking at here, there's a couple of examples. I'm now going to look at a bearish engulfing bar, and that is this 2-bar pattern here. What we've got is we've got bullish price action. We've got a strong bullish candle, but that is followed by this second bar where the high and the low completely engulf the previous candle. So that means that the sellers came strongly into the market. Even though buyers attempted to push price up a little bit, the sellers came strongly into the market, pushed price all the way down and closed below where the previous candle was trading. And that is a strong bearish signal, and it can tend to mean that price will continue downwards from that point. There's another example here. So this bar here, the high and the low of this bar exceed the high and the low of the previous bar, and then we see a move to the downside. Let me see if I can find another. I'd like to find a bullish one if possible to demonstrate both to you. Oh, there's an interesting pattern here as well. Let me just talk about this while I'm at it. We were talking about inside bars. What we've got here is we've got a 3-bar pattern, 1, 2, 3. And what can you notice about these 3 bars? I'm going to throw this over to you guys. Let me ask you the question. What do you notice about these 3 bars? Higher lows, yes. So they are all getting higher. Exactly, yes. 2 and 3 are both inside of the first candle. Fantastic. Well done, Jose. So bar number 1, the high and the low. Bar number 2, the high is below the high of bar number 1, and the low is above the high, the low of bar number 1. And then bar number 3, again, the high is below and the low is above. So these candles are getting smaller and they're all falling within the previous candle. This is what we call a double inside bar. Now, if you remember, the inside bar indicated indecision, like a pause in the market. So a double inside bar indicates extreme indecision. It's still indecision, but it's more extreme than the single inside bar. What we've got is price opening here, it's traded up, it's come all the way down, it's come up, it's come down, it's come up, it's come down. So the sellers have failed to push price lower down here. The buyers have failed to push price higher up here, and that has happened yet again here. So the sellers have failed to push price lower, the buyers have failed to push price higher. What can tend to happen here after this indecision, where neither the sellers nor the buyers are triumphing, once the decision is made, once either the buyers or the sellers overpower the other, it can tend to result in an explosive and strong move in that direction. So that is worth looking out for as well. And yes, exactly, a breakout. So those of you who know chart patterns may actually find it comparable to something like a symmetrical triangle if you're looking at chart patterns, because price is making lower highs, but it's also making higher lows. And eventually what will happen is a breakout in either, it can happen in either direction. If we are trend following traders and there's a breakout in the direction of the trend, then that can tend to be a really nice strong move. Now, what I want to do, there's wanted to find a bullish engulfing candle first. There's one here. So the first candle, the high and the low. The second candle, the low is lower, but the high is higher, and price closes above the body of the first candle. It's even stronger if we can find one where price closes above the high of the first candle. But basically the second candle is bigger, it goes above the high and below the low, and it's a strong bullish sign. It can result in a nice strong move in that direction. What I want to start to do also is combine all of what we're doing here. This is a really nice one actually. Bullish engulfing candle. So this is candle number 1. This is candle number 2. We can see the high and the low of candle number 1, and then we get the low down here of candle number 2, but then price comes all the way back up and closes above the high of the previous candle. So that is a bullish engulfing candle, and that is a very strong bullish signal. What I'd like to do is I'd like to add a couple of indicators on here just so that we can start to relate these things. Okay, I've got a question here. What is the difference between an inside bar and engulfing bar? Okay, the difference is the order of the bars. So if I put a number on these bars, we're always with inside bars and engulfing bars, we're looking at 2 bars. So one bar has to be inside the other, or one bar has to be engulfing the other. And therefore, if I put the number on the bars, bar number 1, bar number 2, engulfing bars, bar number 2 engulfs bar number 1. Inside bars, bar number 2 would be inside bar number 1. So it's all about bar number 2. Engulfing bars, bar number 2 engulfs the whole of bar number 1. Inside bars, bar number 2 is inside bar number 1. So for example, there's one just here. So that's bar number 1, that's bar number 2. Bar number 2 is inside bar number 1. Does that make sense? Hopefully there's a pretty good example here as well. Bar number 2 is inside bar number 1. Do both of them indicate price reversal? Not necessarily. So they can indicate price reversal. Inside bars are more indicative of indecision. Engulfing bars are strong directional bars. So engulfing bars can tend to happen before a change in direction. Let me see if I can find where my engulfing bars were. Engulfing bars, we have a first bar. I'll use this as an example here. It's not the best example, but it is an example. So this bar number 2 here is engulfing. This is bar number 1. And bar number 2 is strongly bearish. So it's a bearish engulfing bar. Price is going from the top to the bottom of the bar, and it's closed below bar number 1. And that can therefore mean a reversal, because if price was going up beforehand, we then have our engulfing bar, our bearish engulfing bar, and it can indicate a reversal and a change in direction to the downtrend there. An inside bar is an indication of indecision, so it doesn't necessarily automatically mean a reversal. It can just mean a pause in the market before price continues in the same direction as the trend. So for example, here we have an inside bar, bar number 2, bar number 1. This bar here is inside bar number 1, but it doesn't actually mean a change in direction. We've already got price going down. What it means is price just breathed in for a little bit. It came up a little bit, and then we have a pause in the market. It's indecision. Neither the buyers nor the sellers are winning, but then when the sellers do eventually win, price continues actually in the same direction as it was traveling in the first place. So the inside bar doesn't always mean a change in direction. The engulfing bar can tend to mean a change in direction because the nature of the inside bar is it's a small bar and neither the buyers nor the sellers are winning that battle. An engulfing bar, the second bar, is a big bar in that direction, either bullish or bearish, and it can then mean that price can change direction in the direction of the engulfing bar. So what I'm going to do now is I'm going to add a couple of indicators onto here and see if we can start to put a picture together of how we can use these in our trading and how we might be able to actually make or use them in a trading strategy. I'm going to very, very simply look at moving averages. So I'm simply going to put a 20 moving average on my chart. I am going to put a 50 moving average on my chart. Change the color to red. I'm just going to use those two moving averages for now. And I'm going to use dollar yen, I think. So if we're looking at trading strategy, now I'm not giving you a trading strategy here. I'm not telling you that you are going to make money if you do this. All I'm trying to do is illustrate the points about reading the candlestick patterns. Now, it's no good looking at an individual candlestick or a series of candlesticks if we don't have a context for that. So we always need to have a context. So reading the candlesticks, we can see that the candlesticks are bullish or bearish pretty easily, actually, just by looking at the color, really, but also the shape of the candlesticks as well. But that's not going to help us in our trading unless we fit it together with something else. So it's part of a strategy, but it's not a strategy on its own, but it very much helps us to pinpoint an entry. So for example, with the moving averages here, in fact, I might see if I can find something a little bit nicer. How about Aussie Kiwi? All right. So if we were to be trading the trend with the trend, then we have to analyze the trend first. So in order to analyze the trend, we're looking at our highs and our lows. So I'm looking for lower highs, lower lows, lower highs, lower lows. So I have a downtrend here. I also have these moving averages pointing downwards. So that is another indication that I have a downtrend. So what I want to do if I have a downtrend is I want to sell. I want to find trades that get me into the market to the downside. I want to sell this market. And therefore, what I want to do is use my knowledge of candlesticks in order to help me find a good trading entry. Now, this is one of those bars that we were talking about. But and that is a bearish signal, as I've explained, because we've got price opening here, coming all the way back up to the top and then being pushed all the way back down. Do we want to sell the market at this point? I mean, it's easy to see now because we can see what's happened with price action since then. Let me put it to you that way. So would we want to sell the market at that point? Anyone answer that question? Would we want to sell the market at that point? Because this is a bearish candlestick. The sellers have taken control of the market and are pushing the market lower. Would we want to sell at this point? The answer actually is no, we wouldn't, because we don't have context. What we want to do is we want to use these candlesticks. Exactly, yes, Warren. We want to use these candlesticks to help us pinpoint an entry, but not on their own. We don't want to just see a bearish candle and press sell. We don't want to see a bullish candle and press buy. We want to put everything into context. So, with that said, where we might want to tend to look out for these candlestick patterns is at the moving averages, because price, when it's trending, overall will be moving down, but price moves in cycles. So it doesn't move down in a straight line, it moves in cycles. And price will always return to its moving averages. The moving averages are averages of price, and by definition, therefore, price has to return to those averages. And so those averages are nice places to look out for potential trading opportunities, because if we're selling, we want to find the best price. We want to get in at the highest price, ready for price to go down again. We don't want to get in at the lowest price and then end up getting caught by the cycle and the retracement. So I like to look out for these candlesticks around near the moving averages. So there's a good example of an engulfing candle here. The high of that candle is higher than the first one. So the high of candle number 2 is higher than the candle number 1. The low of the candle is lower, and it has closed beneath candle number 1. And so that is a bearish sign. It's also around that 20 moving average. So that potentially could be a good place to get into a short trade. Now, again, I'm not giving you a strategy here. I'm just giving you an indication that good places to look out for these candlestick patterns can tend to be around the moving averages. Let's see if we can find any further examples. We've got a really nice one there, look. That's around the 20 moving average there. We've got an inside bar there, which in this case has indicated a little bit of indecision, followed by price moving to the upside. There's another one here. Bullish candle around the moving average, resulting in a really nice move to the upside. If one was to trade when one found strongly directional candles around the moving averages, one could start to build a nice profitable trading strategy using these things. There's another one here. There's in fact another one here. Question, hang on, let me go back and look at that question. Question, is there always a second chance to enter or a confirmation because there is a repetitive pattern everywhere you have highlighted? The answer to that is no, there's not always a second chance to enter. Sometimes there can tend to be a second chance to enter, but not always. The thing to remember though is if you miss a trade, then you haven't lost any money. So if you're waiting for confirmation of the direction and you miss it, it doesn't cost you anything. So yes, sometimes there will be a second opportunity, but if not, it doesn't really matter. I want to have a look at maybe a stock market. I'm going to look at the FTSE actually. Now, this is where we can see the difference between the stock markets and the Forex markets, the currency markets, because we can see here there are a lot more gaps in this market. So have a look at, there's a gap here. So price has closed on this day and it has opened much lower on this day. There is another gap here. In fact, there's gaps all over the place. The market closed here and opened here. Lots of gaps in the markets. These markets that tend to have gaps in, we can look at another set of candlestick patterns. So perhaps people may have heard of dark cloud cover, for example, or piercing line. Let me see if I can try and find an example. If not, I'll simply draw it. So a piercing line, that is where we have a downtrend. We have a bearish candle. So I am going to color that in black. That's going to be my bearish candle there. We then have a gap down. So this bearish candle, it opened here, it closed down here. We then have a gap down. So the next candle opens here. That's a bullish candle. And it closes higher than 50% of the previous day's trading, or of the previous candle. If we're looking at the daily chart, then this would be of the previous day. So we've got a downtrend, we've got a bearish candle, we've then got a gap down in the market, so price closed here and then opened down here. We then get a bullish candle that closes higher than 50% above the higher than the 50% level of the previous day's trading. And that is a bullish signal. So that is a piercing line pattern. Now the opposite would be dark cloud cover, and that is where you have an uptrend. You have a bullish candle. You then have a gap up. So price closed here, but it opens up here. You've got a gap up. You then see a bearish candle. Apologies for my terrible drawing skills with my mouse. You've got a bearish candle there, and that bearish candle, after the gap up, it closes lower than the 50% level of the previous day's candle, and that is a bearish signal. So I wasn't looking at these really on the currency chart that I was on, because we don't tend to find gaps, as I said, on currency charts, but on Stocks and commodities, we can see a lot of gaps in the market, so it is much these patterns happen a lot more frequently. Let me see if I can find one. We do have one here. So the first bar number 1, bar number 2. So bar number 1 is a green candle, it's a bullish candle. Now, I will admit this is not the absolute best example because that candle is not very strongly bullish, but it is an example in that it is a green candle. We then have a gap up. So the candle number 1 closed here, candle number 2 opened up higher, and then it comes all the way down, and it has definitely closed past the 50% mark of the previous candle. So that would be a dark cloud cover example. Let me see if I can find a bit of a cleaner example. Is it? No. This is an example here. Again, it's not the cleanest example. Actually, I'm not going to use that one. It's not a good example. Here's a good example. So here we have a bullish bar number 1. Bar number 2 gaps up. So it's not a very big gap, but you can see how the close of bar number 1 was there and the open of bar number 2 is here. That's bar number 2. So there is a gap there. The market gapped up and then price comes down and it closes way more than 50%. 50% of bar number 1 would be about there. So it closes well below 50% of bar number 1, and that is a bearish signal. Look at the questions. What if a candle starts above the 50% of the other one? Does that count? Yes. Yes, so in this example, for example, we have got bar number 2, it is starting above the 50%. So we actually have to have bar number 2 above bar number 1 because we have to have the gap up in the market for this pattern to exist. Very, very gappy markets over here. Just looking for a bullish example. This is a bullish example. No. I mean, there are a lot of examples here. I'm trying to find one that's really clean and clear. There is one here. We have price coming down. We've got a bearish candle. We then have a gap down. So this candle closed here. Candle number 2 opened down there. And then price came all the way back up and definitely came and closed past the 50% level of the previous day's price action. And again, that is a bullish signal. a lot of other examples of these patterns here. We've got an inside bar here, another inside bar here. We've got the long-tailed candle here. So I very much recommend to you to go through your charts and see if you can start to pick these out and try and pick them out in context. For example, wouldn't it be nice to pick out bars that give you an indication of direction around moving averages, for example? So these bars here, and then you can combine to make strategies. Candlesticks as well, the size of the candlesticks is relevant. Obviously, a very large candlestick like this that's a very, very bearish candlestick, but it's not necessarily one that one would like to use as an entry, because when you're trading, you have to think about where your entry and where your stop loss is going to be, and your stop loss has to be in a sensible place. And for me, when I'm trading, I tend to enter a trade at the top of a bar. So for example, up here, and my stop loss would be at the bottom of the bar. And therefore, if I've got a really big candle, that is going to have a huge impact on my reward to risk on the trade. So that is something that's worth noting as well. If you want to use these candlesticks as entries, we need to be looking for reasonable sized candlesticks to use. So yes, I can have a look at shorter time frame candles. It pretty much is all the same. At the end of the day, all we're looking for is an indication of direction. And so I can look at hourly candles, for example. I can look at daily candles. I can look at 5-minute candles, and I'm still going to see the same kinds of patterns. So I'm still going to see bullish candles, I'm still going to see bearish candles, I'm still going to be looking out for the same patterns and the same kinds of things. Are they around the moving averages, for example? If that is going to be something that I'm looking out for. That's a nice engulfing candle there. We've got this very tiny candle in here, and then a strong bullish candle which takes out the low and the high, resulting in an uptrend. So yes, we can look at these exact same patterns across any time frame that we want to. So one final question just before we draw it to a close. Just have a look at that. Question: if the moving average is above 50, is it a signal for bullish? That's kind of veering off the topic a little bit. The moving averages I've got here are the 20 moving average and the 50. If the 20 moving average is above the 50, that can tend to be a signal for bullish. But again, it has to be in context, because you can see here that actually we have periods of time where here we've got it above, here we've got it below, here we've got it above. And if you use those signals as buy and sell signals, you can get caught out quite badly, because when the moving averages are sometimes above, sometimes below, they're weaving in and out of each other. That can be a very tricky place to trade. So the answer to that is yes, it can mean that, but it has to be taken in context. Okay, so we have reached the end of the hour. I really hope this has been useful to you guys. We'll look forward to hopefully speaking to you all again in one of these webinars in the future. Do make sure you keep up to date with which webinars are going on, because we do these relatively frequently, and I'd love to have you back in another webinar at a later date on another topic. So thank you very much everyone for tuning in this evening. I know it's a little bit late, it's 9 PM now, so hopefully you can go and get some rest, and happy trading. I will speak to you soon.